I've got more of the most underutilized, underused tax benefits, tax deductions, tax credit, part 2 coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, this is part 2 of talking about some of the most underutilized and underused tax deductions and tax credits. Guys, I could talk about this for hours and hours. You know that because many of the videos that we share here on the Wise Money Show channel relate to tax planning. Tax planning is one of the 6 areas of your overall financial life. It's part of your financial life, my financial life, and the whole goal of tax planning is for you to pay the least amount of tax over your lifetime, if not multiple lifetimes, multiple generations. Well, how do you do that? Okay, you identify opportunities for you to improve your tax picture. And then through looking at all 6 areas of your financial life, you determine, well, are these opportunities ones that I should go after? Or is there something else going on in my life where I need to, that's a good opportunity, but it's not right for me this year or this time, and I should hold off on it. Identifying what those opportunities are. So some of those underutilized or lesser known tax deductions and tax credits, that's part of the job of your CFP. And I shared in yesterday's video 3, they ended up being long, 3 of the most underutilized and underused tax benefits. I've got 3 more right now. Okay, so the fourth, carrying on from yesterday, underused tax benefit is when you're over age 70 and a half, not getting a deduction on your charitable contributions, not getting a charitable deduction on your charitable contributions. And here's why I bring this up. All throughout your life, you're making, if you're supporting some causes, going to church and donating, you're just making donations out of your income, okay? And you're looking and saying, well, do I itemize or not? Am I getting the tax benefit for this or not? I'm not doing it for the tax benefit, but I'm doing it because I feel called to or led to or I care about this cause. And if it gets me a tax benefit, great. And there are some strategies to lump contributions or use a donor advised fund. We've talked about those before, but when you turn age 70 and a half, if you're still doing it the old way, odds are you're not getting the tax benefit when you should be. Okay, so here's what I mean. You're in retirement, you've got your Social Security, and you're drawing money out of your IRA as well to supplement your income. And let's say you're drawing $5,000 a month out of your IRA, although that number really doesn't matter, okay? And, throughout retirement and everything, you've got $500 a month going to the church. So you've got your Social Security, you've got $5,000 coming out and out of your IRA, hitting your bank account on the 1st, and every single week you're donating to the church, whether that's in the offering plate or online or whatever, and a total of $500 a month is going to the church. Well, in that instance, likely you are just getting the standard deduction because you're in retirement, you don't have a mortgage, you're not paying a ton of state and local taxes because Social Security is not taxed to the state, and so you're not itemized. So those donations, that $500 a month you're giving to the church, it's not helping you on your taxes, and that's okay. That's okay. But at age 70 and a half, you are eligible for something called a qualified charitable distribution. And most people, when they learn about this, they're like, yeah, but this is just how I've always given to the church, and do I really need to change things? Yeah, and here's why. If you changed, instead of drawing $5,000 a month out of your IRA, what if you switched it to $4,500 a month out of the IRA? And you added a withdrawal out of your IRA of $500, and instead of it going directly to you, it goes to the church. In that scenario, the church is still getting their $500, you're still getting your net $4,500, everything's the same, except Uncle Sam is not taxing you on that $500. Uncle Sam, that $500 that goes directly from your IRA directly to the church does not land on your tax return as taxable income. This is a way of you essentially deducting the donation you're making to the church or to that charity without having to itemize. You've got to be age 70 and a half. The money needs to go out of your IRA, not a 401k, out of your IRA. It's got to go directly to that qualifying charity via this qualified charitable distribution. So, fourth underused or underutilized tax benefit is not doing a qualified charitable distribution when you're age 70 and a half. You might be listening and saying, doesn't apply to me. Okay, then when you get to age 70.5, be aware of this. But second, talk to your folks about it, right? Because normally this is underutilized and underused, not because it's not a good idea. It's a fantastic idea, but you've had a whole life of habits of this is how we do our donations. And at age 7.5, when you want things even and just the same, this probably needs to shift in order to improve your tax situation. Better yet, or good news on top of good news, is this qualified charitable distribution counts towards your required minimum distribution. So be aware of that, work with your CFP on that. Fifth underutilized tax benefit is not contributing as much as you can to a health savings account. Now, why would I bring this up, guys? Of all, again, we do, over 3,000 tax returns a year. This is probably the most common one that we see people missing out on, because the mentality is still with the HSA. Well, how much in medical expenses do I think I'll have this year? Okay, $1,000, I'll contribute $1,000 to my HSA. The mentality for most people is still that it's use it or lose it. And you might already know, you might say, no, I know that. Guys, we get the comment, anytime we're talking about HSA planning strategies, get tons of comments to the videos saying, wait, I thought it was use it or lose it. The HSA is your money. An FSA, a flexible spending account, that's use it or lose it. An HSA is your money. This is not use it or lose it. Your contribution goes in pre-tax, okay? While it's earning interest, or if it's invested within the HSA, it's tax sheltered. And then when you withdraw dollars from the HSA for qualifying medical expenses, either at the time you incur them or to reimburse yourself from a previous one that was eligible when you had an HSA, or on or after having an HSA plan, high deductible health plan, those dollars come out tax-free. It's a trifecta of tax benefits. It's the only one that I know of where you get pre-tax in, tax-sheltered growth, and then tax-free out. Therefore, the mentality needs to shift from, well, how much do I think I'll even have in medical expenses this year? Instead to, well, based on my plan, how much can and should I contribute to my HSA this year? Because the thought of just funding as much as you think you're going to have in medical expenses this year, it ignores the fact that you're going to have a ton of medical expenses out there in the future. And obviously with inflation and everything else, there will be more and more medical expenses that you have to bear out there in the future. And therefore, building up a balance in your HSA, that actually could be a very good thing for your taxes. So one of the things, again, in this space, between getting your tax return prepared and filing it, is you can look and say, you know what, we only contributed $2,100 to the HSA. There's an extra $2,000 that we can do, or whatever it is, up to the maximum for your given situation. That would increase your refund. Do we have the cash flow to contribute more to the HSA? And then the sixth underutilized tax benefit we see all the time is contributing to the wrong 529 plan. Contributing to the wrong 529 plan. Here's the deal. With 529 plans, these were originally college savings plans, but now I would just call them education savings plans, because you can use them for college, but you can also use them for tuition for K through 12. There's even now, starting this year, the ability to move dollars from, there's a lot of hoops, a lot of restrictions, but move dollars from a 529 plan into a Roth IRA as well. So 529 education account, every state has one. In some states have multiple, okay, a couple. But not every state offers a tax benefit. And if they do, then it's just on that that specific state income. Here in Indiana, we have, I would argue, the best tax benefit of any state out there. On the first $7,500 that you contribute to the Indiana 529 plan, you get a 20% state tax credit. Well, here's the deal. That state tax credit is just on your Indiana state taxes. So if you don't pay Indiana state taxes, but you're using the Indiana 529 plan, you're not getting this benefit. Let me say it differently. If you live in Indiana, but you're using a different state's 529 plan, you're not getting this benefit either. And even though this is rare, we still see this where someone either moved states and they're still funding the same 529 plan, their old account, or they're not aware of their state's tax benefits for using that individual state's 529 plan. Because there's no requirement that you live in Indiana, you have to use Indiana's plan. That's not a requirement. Also, It's not a requirement that, well, my kid's got to go to college in Indiana, and if I use the Indiana plan. No, you can use any state. There's two types of 529 plans. Prepaid tuition is the one where you've got to use that. You use a school, an eligible school in that state. Most people don't use that. Most people are using the savings account, the 529 savings account, and therefore your kid can go to any school. It doesn't matter what state they're going to school, what state 529 plan you're using. So to make sure you're capturing this tax benefit is stay up to date on your state's laws and benefits, tax incentives for using your or their 529 plan. Then, once you know what those rules are, maximizing those benefits, again, looking at all 6 areas of your financial life, but to get the most out of your tax planning, maximizing those tax benefits for you. Okay, so there you have it. Those are, combined with part 1 and today's part 2, 6 of the most underutilized, underused tax benefits, either deductions or credits or adjustments that you can make to improve your tax picture. This is all part of comprehensive financial planning, and one of the 6 areas of comprehensive financial planning is tax planning, identifying opportunities for you to pay the least amount of tax over your lifetime, and then helping you make decisions to say, yes, this is one that I should implement. No, this is one I should pass on. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.